So we've all heard this statistic. 90% of traders lose in the markets. So why is that? And how can you be part of that 10% that win? That's what I'm going to dive into today. So starting with the data, how many traders actually lose money? What are the real statistics? Well, ESMA broker discloses 74 to 89% of CFD and Forex accounts lose money. India derivative studies show that around 91% of individuals lost money in 1 year. Other data sets, they typically find that 70 to 80% of retail traders are unprofitable and lose money. So what we see is that losses are concentrated in leveraged short-term trading products. Now, does that mean you have to be scared of short-term trading? Well, yes, in a way, you need to respect it, but there are some very simple tips that I'm going to give you today that can turn you into one of those profitable retail traders. Because it's like anything in life. People love to gloss over this stat that trading is impossible to be profitable, which is not true at all. Because 90% of businesses also fail. It's not just trading. The 80-20 rule, or what I sometimes prefer, 90-10 rule, Pareto's principle, plays out in all areas of life. Anything worth achieving is always going to be available for only the minority. That's just how the world works. So you need to be part of that minority, and that starts with believing you can be. So forget all of these statistics about 90% of traders lose money. You're going to be part of the 10%. So you need to follow the habits of that 10%. So win rate versus profitability. What's actually interesting in that data is that 65% of those retail traders record win rates above 50%. So they actually win more often than they lose in their trades. 82%, they still lose money overall. That's kind of the rough figure as described in the last slide. And what this shows is that winning more trades does not guarantee more profits. And it starts to uncover the issue when it comes to retail traders. Average loss size, so your risk management, matters more than win frequency. And this is exactly what I teach and exactly what I'm going to dive into now. Win rate, risk to reward, expected value, and understanding leverage. These are terms you must know as a trader. In fact, you shouldn't be trading live in the markets if you don't know all of these terms and fully understand them. So let's dive into it. Win rate. It's very simple. It tells you the percentage of your trades which won. Now, win rate, it's calculated as the number of winning trades divided by the total trades times 100 to get it as a percentage. But win rate alone is not enough, as we can clearly see, since retail traders win more than they lose, but still 90% of them lose money over a 1 year plus period. So on its own, win rate is just a vanity metric. It's what people use to get you engaged into trading, but it's not enough alone. As mentioned, many profitable traders actually have less than 50% win rates. I personally have systems with 35% win rates that are profitable over time, because it's not about win rate, which I'm going to dive into later. But first of all, you need to understand risk to reward. Having a high win rate is great, but it's nothing without also knowing how much you stand to win each time you're right, and also how much you stand to lose each time you're wrong. That's risk to reward. So risk to reward details how much profit, the reward, you aim to make for every single unit of potential loss, your risk. It's measured in units, not just dollar amounts. And it's crucial for assessing how profitable your strategies are. And it's also a powerful mental framework for decision making just in life. Assessing every decision in terms of the risk and weighing that up against the reward. Is it optimal? So for example, you're risking $100 to potentially earn $300 in a trade. Also, another example, you're risking $1,000 to potentially earn $3,000 in a trade. Both examples reflect a plus 3R winning trade if it goes on to win. So one unit of risk equals 3 units of reward. The dollar amounts do not matter. That's how professional traders operate. And that allows you to then calculate your expected value. So expected value, otherwise known as EV, is a formula that tells you in simple terms whether something is worth doing. If you get a positive number, it's called positive expectancy. That means if you take the same trade setup a large number of times, you should expect to make money on average. This is absolutely huge. That tells you that you have an edge in the markets and doesn't have the pitfalls of win rate, because it actually incorporates both win rate and risk to reward to determine whether your strategy is profitable or not over time. And you simply let the law of large numbers play out once you find a strategy with positive EV. Doesn't matter about win rate. Again, it's how much you win when you're right minus how much you lose when you're wrong over a large amount of trades. That gives you your expected value, which in other words is your average returns per trade. So if you get a negative number, this is called negative expectancy. That means if you take the same trade setup a large number of times, you should expect to lose on average. And this is also very important as it shows you the systems and trades that you should be avoiding. And you can also have an above 50% win rate with a negative expectancy system. That's why expected value is so important. Retail traders, they just focus on whether they win or lose, but that does not give you profitability. It's all about expected value. And if your system has positive expectancy, what I always recommend is that you begin live trading to test your system in real time. If your system has negative expectancy, always recommend that you test more until you find a system with plus EV. You don't go live into the markets until you have a plus EV system. And what I describe as positive expectancy in backtesting is a system with above 0.3 EV, because you have to factor in for trading fees, slippage, execution errors, which almost always affect the EV when it comes to live trading. That means negative expectancy is anything below 0.3 EV. This allows you to be a professional trader and build winning systems that actually allow you to be profitable, not just looking at win rate, that doesn't matter, but actually testing your systems and deploying them live in the markets when the data shows you that over time, the average returns of a trade in that system, if you take a large enough number of trades, yield a positive return. So once you understand that, from there, you simply need to understand leverage. This is when you can now go into live trading with your systems. And leverage is, of course, where most retail traders go wrong. It's short-term trading, as the studies showed, using leverage. But leverage should not be scary. It's actually a tool to size your positions when you're trading correctly. Because look, guys, trading isn't easy. It's a challenging game. Smart traders, they know how to use leverage to their advantage. They profit from traders who are careless, overconfident, or uninformed. So we're here to show you how to think and trade like the smart money, and you have to understand leverage. So leverage actually comes last. It doesn't matter how much leverage you use in a trade. What matters is how much you risk on each trade. For example, if you have $1,000 and want to risk 1%, your stop loss should be set to lose $10 regardless of leverage every single trade. That means you could have an 100x leverage trade, a 20x leverage trade, 5x leverage trade. It doesn't actually make any of the trades more risky than the other. That, of course, is as long as you're above your liquidation price when it comes to your stop loss. But the point is, whether you're 100x leverage or 5x leverage, it should not affect your risk, because your risk is based on your stop loss, which takes you out with a fixed amount that you predetermine before you ever even enter the trade. And therefore, leverage is simply there to allow you to position size correctly. Leverage is actually a tool for capital efficiency. It allows you to borrow from the exchange, which then means you don't have to keep all of your capital on the exchange and have that third party risk. You can actually therefore reduce your risk by using leverage as a tool to size your positions. And it's only after you've determined your entry, stop loss, and position size do you actually allocate the leverage to the required amount for the trade. So the leverage is going to be different for each trade because it's all about how much you risk per trade and your position size. Now, a lot of traders, they don't understand that. They think 100x, 150x leverage, that's crazy. You're risking too much. But professional traders know that it's about position sizing, not the leverage number that matters. It's how much you risk per trade. And that allows you to get your risk to reward for each position. Because it all really comes down to risk management when it comes to getting into that 10% of traders that are profitable over time. And a famous quote reads as follows: manage your downside and the upside will take care of itself. What this means is, as a trader, you should be always focused on the downside. How much risk do you have on the table at any given moment? Go through all of your open positions every single day. Remind yourself of, if all of these trades went and hit the stop loss, how much am I risking? Is that number responsible or is that number irresponsible? And that's going to be determined by the percentage of your portfolio that is at risk at any given time. It's the downside that takes traders out of the game, because capital is your oxygen as a trader. Trading is a cash multiplication skill, not a cash flow skill. You need money to make money in trading. Therefore, if you run out of oxygen, you're out the game. You can't even play, even if you do have profitable systems. In fact, I could give you a profitable system, but if you don't have risk management, you could blow up your entire account and I could print year on year on year. So risk management is literally the defining factor very often between becoming profitable or being unprofitable. And that's why they say manage your downside and the upside will take care of itself, as long as you're putting in the work, building systems, trying to hunt for that edge in the markets, build plus EV systems, taking them live once you have enough data. The upside then comes just from taking trades over time, taking 50, 100, 200 trades of that same system, letting the law of large numbers play out. But it's the downside that can make you lose it all in a day. The upside, you can't win it all in a day. You can't make tens of millions in a day, unless, of course, you have a multi-million-dollar portfolio, billion-dollar portfolio. But you can lose it all in a day. And that comes down to your risk management. So to be in the 10%, you need to understand win rate, risk to reward, expected value, leverage, and all of those things allow you to manage risk like a professional. And from there, it's just a game of finding edge and letting time do the rest, as long as you manage your downside. So that is how to become the 10%.